Okay, good afternoon and welcome back to today's class. Today is we're having our week 2, day 2 class, and today's 27th of September. And yesterday we introduced the concept of liquidity, right? And we said, let me just close my Discord. We define liquidity as money, and that liquidity areas are areas where we have piles of orders placed in the market, either in buy forms or sell forms, right? And we said that institutions, when they want to convert huge sum of monies, they actually need high volume of liquidity in the market to enable them to do it and be profitable. I give an hypothetical instance of let's say US company wants to convert millions of dollars, or let's say $1 billion into euros, right? If it pumps all that money into the market once, there's going to be a spike. There's going to be a hike in price. Like you can see these major spikes just happening, boom. And that will cause them to be in loss, right? So their target is to always look for areas of liquidities where they can use as leverage to put in money into the market. So thereby they are looking for sellers. They're looking for where sell orders will be residing. Okay, so liquidity is basically the fear of the market. The market moves from one area of liquidity to another area of liquidity. Every single candle, every single atom of price is liquidity in itself. However, where is the area where the banks are targeting as liquidity zones in which they can pump in money? We went through some types of liquidity. I would say swing points are normally liquidity areas. Why? Because for each swing point, for each swing level, there's liquidity resting above it. And from this example, you can see it right here. See liquidity resting this higher high, this higher high, this higher high. So why there's external liquidity resting here, the price will also look for the internal liquidity in which it can reverse from to take out this high. So this becomes a liquidity to take, and here becomes a liquidity to target. Liquidity to take, liquidity to target. So once it takes this liquidity resting in this range structure here, what happens? It targets this new high. That is why it goes. So where is my Discord? Give me 1 second, please. The next kind of liquidity we'll look at resistance and support liquidity. And we said that normally we have areas where price always come and test over a period of time, and we see that those areas are always respected. So that may be on the buy side is resistance, and on the sell side is support level, right? So we said that these areas also act as liquidity areas. Why? Because where price comes tap here, and doesn't break, it has left a lot of sell orders hanging around here, and also buy orders waiting for the breakout to trade. So a sweep in these areas will be a sweep in liquidity resting on these areas. They will look at fair value gap, which ideally it's also a kind of liquidity, because as far as it attracts the bank to go back, when bank pumping volumes of monies into the market and leaves this imbalance in the market, they will actually look for strategies to come back and fill these balances, right? So that will be liquidity that they'll be searching for liquidities to take around here to target this fair value gap where they can get price at a cheaper level, then continue price down. And I gave this I added this drawing as an added example. Why? If we're in a bearish market structure, right? And then there's this fair value gap that caused a break of structure, for instance, so the downside. Let's assume our break of structure happened here. So we have here to here, right? And leaves this fair value gap. More often than not, what you see before price retraces back to the other block is that price tries to form some kind of liquidity build up around here. And from this example, we can see this liquidity building up very beautifully here, consolidating, making a double top. And what happens? For instance, if we see some retail traders now who see this as a double top and then they get into price here, thinking that the price is going to go down. But what happened? They are taking out. A stop loss is triggered. Why? Because the bank is looking for how to fill in some areas of this liquidity. It could even fill it up to the order block itself and then push price to the downside. Then lastly, we also talked of double top and triple tops. Now, many times when the market makes these head and shoulder patterns or double top, as retail traders would love to trade it. So those are also areas of liquidity because the bank is looking to how to raid the buy side liquidity and the sell side liquidity and then push price in the opposite direction. Just as we are seeing in this case here where price came from this bullish price bullish here, and then what it makes a series of triple top, right? And then more often than not, what you see is that before price you actually take off here, you'll see that there will be a sweep of liquidity to the downside, and then the retail traders who like to sell this market will sell. Why? Because they believe that this has broken below this level, so they open their sell positions with their stop loss hanging here. And what happens? They are taken out, as well as the people also the buyers too. The buyers also have something like this at this point here. The time when price came, made it up top, so they may actually open their buy position here with their stop loss resting here. That's in the case where here swept out. So yeah, and then what happens? They get stopped out. Today, the next kind of liquidity we'll be looking at is inducement. So the next kind of liquidity we'll be looking at is inducement. Now, what is inducement, or what do we call inducement in Forex? First and foremost, inducement in Forex are areas where there are levels that rest below liquidity in such a way that you may be fooled to take trades off them with the belief that they are in the right zone. So inducement, like the word implies in real life, it's to induce you. So if something induces you to do something, then you do it. So it doesn't get more complicated and or more easier than that. So inducements are areas in the market that makes you feel like you have to like get into a trade at that level, whereas it is just an inducement. They are not actually correct. So if we look at a chart pattern that forms like this, okay, let's say we have a supply zone here. You have something like this. There was something like this here. You have, let's say, liquidity here, resting here, 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 here. Yeah. Okay, now I'm going to use this first to start before I continue drawing it. We'll draw it in different ways. So now this can also be a form of inducement right here. Why? Because we see that when price is bearish in this market structure. So what do we see here? you see that price is bearish. It made this low, right? Made this low here, and then this other small retracement followed it, and what happened? Came all the way down here, built some kind of liquidity that was resting here, build liquidity resting here. Okay, took out, swept liquidity from downside up here, and then we see something resting here. We'll look for a kind of we say kind of supply zone here, right? So this become an inducement because this is a false supply zone, whereas there's a major supply zone resting here. So what happens is that the price or the pattern of the market induces you to get into a sell from this other block, where we also have maybe some areas of liquidity around here, and then you are induced to take a price from here. So what you see happening is that price will actually induce you to enter sales from this place and then take you out. Maybe come here like this, does like this, does like this, does like this, and then we see that price comes here, comes here, comes here, comes here, comes here, and then all the way down. So this is the area in which price induced you to get in the market. So in actual fact, this level is also an area of liquidity. Here, liquidity is also resting there, in form of an inducement. All right, so that's all for inducement. But you must understand that many times inducements are always they always look very well presented, that you may feel like, if I'm not in this trade, then I'm losing out. Inducements are things that actually induce you to actually go against maybe your rules, or to make you feel like you're going with your rules and you don't want to miss out. So many times are not, inducement always, if this basic liquidity doesn't get this smart money trader, this one would, because this will get those who are not even patient. This will get those who are feeling like they are patient, but at the same time they actually are not. If you have a rule-based system, you have to wait for everything to click. You have to weigh all the options on the table. You have to look carefully. Forex isn't so anybody can really say they have the idea of their game 100, because there are many times whereby things may look as you feel until you look again. It's like reading the Bible. There are some verses in the Bible you read once, and then when you read it again, it has a different meaning to you. So if we are looking at the chart here, what can we see? Let's look for some areas of liquidity now and how price reacted off of them. To this level. Now for me, since I can see that the market has respected this level previously, causing like there's a big change of character here, because we are swinging from this low and now are now going high, right? So since I see that market has respected this area before, and I see that there's now a change of character from this bearish order flow now to a bullish order flow, this would have been a valid order block for me all the way here to the low of this candle, and this would have been more or less an inducement, because I would anticipate that market will want to like fill this area, this level of this imbalance here is going to mitigate this area before going up, and that's exactly what price came and did here when it filled here. If you go into a 15 minutes time frame or a smaller time frame, you will see that there's also a retest on this candle here for whatever change of character it would have initiated here on the smaller time frame. So this area was mere inducement. Hence, okay, I don't have still liquidity. All right. So what other liquidity can we spot? Okay, this area here. Okay, same thing here. What do we have here? We have this high. I took out this low, putting in this new low. Here we have this build of the market building here, giving us this area here, leaving us with this area here as a form of an order block. Why? Because there's this fair value gap here. But what do we see? That we see that price came in, did not test it, went down. So this will also make you now feel that this is the order block to be tested. This is a clear case of inducement, because we have this area here, we have this order block resting here that leaves what? A fair value gap. This is the origin order block. This is the origin. Then maybe this can be an expectational order block from this entire price leg, from this high to this low. But what we see is that when price actually broke this structure to the downside, it left this area here with this unmitigated zone, and also made a consolidation around here. And if you look closely, you can see that there's liquidity resting above here in forms of equal highs. If you go into a lower time frame, like a 15 minutes, you see that there is this form of consolidation here, which is the liquidity to possibly target, right? So when price came all the way down here, since our order flow is bearish, our like external order flow is bearish, we should be looking for how price can come into these areas and then give us a continuation to the downside. If I draw my Fibonacci around here, it would have also made me feel that this 50% level is actually valid, because you can see that the order block is just resting on the 50%. Now, don't get me wrong, it doesn't mean that the price can actually come here and test it to go down. That's why it's called inducement, because it will make you feel like all your confluences are correct. However, what the case really is here is that this order block was here to induce sellers, early sellers, to go into the market, be smart money or whatever kind of trader you are, to get into the market at this level. Here, target the low, right? But what happened? We see that price came, it kind of like let's say respected the order block for it, came here, actually went down, played until what? It took us out of the market around here, right? So it took us out of the market around here, which normally, I just want to make this clear, right? This is not a bad trade. So if you actually took a trade here and it gave you a change of character and all that here, and it went and it took you out on stop loss, congratulations, that's a nice trade, because you risk 1:5.4. I mean, so if you can have 10 trades like this a day, and be sure that you get at least 5 or 6, and then with your risk to reward of this, you'll be in profit. So this is just, it's a print, because personally for me, I would have taken this trade here, though I'll be looking at how price has not yet swept this high. But I wouldn't really care if I see that it has given me my change of character here, just to make that very clear, right? So you traders must always lose. It's not you must always win. So whoever tells you that is lying. Then, but what happened? We see that price now came, tapped into this order block here, came down. So one may have mostly entered into this here. So I think they call this a stop hunt, or we'll teach that maybe tomorrow anyways, and all that. Or even another form of inducement. Because on a smaller time frame, you see that it came here, did the change of character, tested and all that. But what happened? If you entered into this trade here, it's not a bad trade if you are not being too precise with your stop loss, because more often than not, you see smart money traders trading and they do something like this here. They'll say, okay, this was the point where it changed. I'm going to put my stop loss like here, and then they'll target this low, right? So they can get 1:9. Whereas if you had actually just targeted this high here, since you can also see that there's this level, this double top here, and you see that price may likely come back to enter into this order block fully before test going downwards. if you had put your stop loss just slightly above this high and targeted the low of this place, that would be a 1:2.78, right? So that's just how liquidity. So in this kind of schematic that is building here, you can actually see that the banks are, or the big institutions are, literally filling in these orders in a systematic way that causes them not to lose money. So while orders may be placed here, they'll put pumping money that makes the price to be pushing it downwards, and then you'll be so happy that yes, this order block is respecting, that's giving all your confluences, but then it takes you out. You come here, it taps into this order block, and like, oh, finally it's mitigated. What happens? Comes here, if your stop loss was resting above here, it takes you out. So the safest way will always be to trade above the origin order block. In some cases where the origin order block is close to this one, especially when you've lost something like this, you want to be sure to ensure that you get in the next order block with precision. And you see that this market actually took time. Stayed here, took out this low, until we broke and took out take profit somewhere around here. So I think that'll be all for today. That's all the examples you can actually look at. It's an example seated here. Let's see. What do we have here? Let's see. Okay, this level. Price actually bearish, so maybe we'll be looking for a change of character somewhere around here. So the expectation out of that flow was to take out this low. So since we didn't take out this low, we put in this high, which was taken out here. Okay, what can I see? I can see liquidity that was resting here, and here. Liquidity building here and here. This was liquidity building, taking liquidity. Okay, I think this is it here. That's what I marked here. So I think here we said that price came here, put in this high point. I see putting this low to this high here. So price came when you broke this level here. All that be expecting, I think price will take off from around this area here, right? Which it actually did. So you see that those liquidity that was building up here, price came here, built up this liquidity to tested it and continued, and price came back down to retest this same order block, sweeping out this entire liquidity that was building up here, and actually continued. Well, this is more of a complex liquidity, but I'm sure that you get the basics of the fact that the bank will always make, the institution always make price to move to where there are high orders in the market. So why it may not be so beautiful to be just picking out textbook print of liquidity zones here. If you are trading in real time, you have to be able to identify liquidities as they come, or as you anticipate. And one of the best way to do that is to first understand your order flow in the market, followed by proper market structure, and also you define a valid order block and all that. Ensure that you have liquidity to take and liquidity to target in every trade. You see now, okay, I don't know when I put this arrow right here, but I was expecting that this price will come up here and then continue all the way down. You see, but it never came up. Instead, it just did this and kept on going down. Now, also importantly, there are also liquidities that fails to close in. And then they don't make them invalid. Let me give you an example. We can have a market build up like this, right? So let's say that this is our, let's say we have a strong 4-hour support. This is our support level, right? And it's very strong. So in this support level, we see what price came in, tested it, tested it again, put in this low, put in here, tap here, tap here. How that would look now? Let's see. Put this. Now this is complex. I'm trying to paint a real market scenario here for you. Put in this. Put in this. Put in this. Put in this. And put in this. All right. I think this is wonderful. All right, so now this is complex. This is what we see normally in the market, so don't worry. Now let's break this down. Firstly, we have a strong 4-hour support level here. Right, so we have a strong 4-hour support level here. I will see that price has come and tested it several times. Now let's look from the retail perspective. This, remember, I would say that support zones and resistance zones are what? Their liquidity area. So we have liquidity resting below support. All right. So these are liquidity resting below support. So this whole entire area is liquidity that's resting below the support level. All right. Now, in like market scenarios, what do we really see? When price came here and tested here twice, came here, tested here, came here, tested here, normally we see early buyers entering from here, right? So sometimes we see that this will be a place where we'll see early buyers jumping into the market, be like, oh yeah, it's going to go back up. Let's dive in. So we have what? Early buyers here. Okay, we have early buyers here resting here, and what happens to them? Let's give them their long position from here. So their target will be this high and their stop loss will be resting below this strong support level in quotes. And what happened? They are stopped out, right? Then what are the next set of people that we have? The next set of people that we have are the people that trade breakout, retail as well. So now, wow, it came here. Remember that I put in this short low, so it's not like it had a big low and came. It put in a short low to show that the bearish momentum or this support is going to break. And when it broke this, they waited for a retest, and then bam, I called the trade. So when they call the trade, they'll be targeting maybe a low somewhere around here. What happens? They are taking out, boom, and then they'll be like confused, like, why? What's going on? But I waited now. So these are breakout sellers. So breakout sellers have entered into the market here and were stopped out here. And then price came here. Maybe it did not test, maybe it tested, whatever. And came here. Then we now see that we may have another block here because this is now a change here. So we'll have other block resting here. So this is where smart money traders may now buy and take, because now we see that this has taken out the sell side liquidity resting here, all right, and this has taken out the sell side. So for the people that sold, they've been taken out. People that bought here, they have been taken out also here, but really the liquidity may even be resting at just the top here. So what we may see is that price may take these sellers out, right, come up here, break this structure here, right, putting a change of character. Remember when bearish, putting a break up, remember when 4 support. So this is a 4-hour time frame. So price may now come, take out this major level here, this high. Now, don't even get me wrong, it doesn't mean that you cannot get an indication from this low time frame of the change of character that happened to even buy into this level, right? From the 4-hour perspective, you see that price came and took out this high, causing a change of character on the 4-hour time frame and leaving this area of support. Now, price came here, maybe tested it one time because this is the first price leg. Tested one time, made a break of structure to the upside and left this inefficiency here. Probably within this range, you may also see some liquidity to take. So when you're taking out that liquidity, this will be your liquidity to target, right here. So that's one very good scenario. So one, you may actually know that there are many times where price will actually sweep out a level that you are holding strong in terms of liquidity, right? So let's say you had something like this. Let's say you had something like this. You had price ranging like this, right? You had this valid, let's say a bearish scenario and a bullish scenario, and then you had this other block here. Now you may see that price may actually come here, right? It's respecting this other block to go down, right? Oh no, sorry, let's do it like this. So we now have a change of character. So now you will notice that price may actually come here, right, and do something like this. I would like to draw it anyways. Hold on, I will make a drawing before coming downwards. Now, what happened here in this scenario? We have a break of structure. We have another you fail to take out this side, so we have a change of character here. So change of character now leaving us with this valid order block. With this valid order block resting somewhere here. But now you see that price actually raided this other block. Now I want to paint out the picture of what could have happened here. So if we have something like this happening there, right? Let's use green. So I have something like this happening in this area. So let's say that this area here now, this is the high. This high here is resting here, right? It's resting here. So this high is this area, okay? While this one is this area. Now we see price resting here. This is where our order block is. So let's mark it as our order block. Good. So this is our order block here, right? But then you see that this price came here and there's a wick like this. There's a strong wick here. But you see that the candle failed to close above this order block. It doesn't actually mean that it has, for me personally, it doesn't actually feel that it has invalidated this order block, that price may not retrace from here. Because many times you see that price always read out, maybe to sweep out, maybe there was an equal high resting somewhere around here within a valid order block. You see that price can try to come leave this week but close within the order block. So when that kind of thing happens, in my own way of trading, that's why I don't always get into a trade off order blocks. I have to wait for other confluences. So in that kind of instance, what you do is to wait for the next 4 hours to see what it's going to do, because this 4 hour may actually still come, do the same thing and close inside the order block. Okay guys, so yeah, sorry about that, there was a break in transmitting. Okay, so what we are looking for within this order block is to ensure that price, even though the wick may come out of the order block in itself, you want to ensure that this wick, this kind of candle body, closes inside the order block or even below the order block. Then you check for other confluences like break of structure, change of character and whatnot within this order block, or maybe a buildup of internal liquidity. Okay, so I think there was a pair EROJPY. I think that was the pair. Okay, did I take a trade here? Yeah, I think I can see a trade here. So I've been on a 50-minute time frame. Okay, maybe 3 minutes. Oh no, I think it's ERAUD. Yes, it has to be this. So let's go on the 45-minute time frame. Okay, what can we see here? So we see on this 1 hour time frame. Oh, I think it was before. Okay, so on this 4 hour time frame, we see that price had made this low, right? And then putting this high and putting this low right here, leaving behind this other block, resting gently here. Okay, so because this is the only area that has not been mitigated after this break in structure to the downside, right here. Okay, so within this price leg, this is the area that we're looking to trade off of. And you can see that going from the 4 hour perspective, you see that the candle has raided this other block, right? So it can also be trying to sweep out liquidity that may be resting within these zones. The fact that this price has come here does not mean that it has taken out this liquidity. You get? So it doesn't mean that others may not still be resting in this zone. That's what it's just key that you understand that concept. There may also be liquidity resting above here in terms of these equal highs. And you see price did not raid it out. So what happened is that price came, raided it. So this is 4 hour. Let's go down to 3 hour. What happened? 3 hour time frame, raided it. So if I taking a sell from here, if I was among the school of traders that open trades from here, of which they are not actually wrong, I put my stop loss here. Why? It will come in, tap in, and then take me out. And then I may feel like, oh, it's raided, I can't trade it again. No. So what you have to do is to wait for a 3 hour candle to close and see where it closes. If this 3 hour candle closed above this, if it closed above this line, then I may look to maybe not enter it again because I feel like it's raided. So it's already broken the structure, right? Or it has caused a change in character. But what happens is that the body closed below this other block or within our other block. And then I'll have to wait for the next 4 hours. And that's what happened right here. This was the next 3 hour candle that opened here. And you can see it also went up, but it closed inside, right? So closed inside, and that is why you see it pulled down. I saw this engulfing candle here, which was my first indication that this is respecting, right? And then caused an order block where I could have traded off of. So I think I entered this on the smaller time frame. So let's see. Let's spot the exact entry. Oops. Okay, let's look for this exact entry. Okay, so this was when we raided. This was when we raided the highs right here. But you see that price came back, make this series of lower lows, lower highs, lower lows, lower highs, lower lows. And what happened? This is all I needed. I needed to see this break here from this price leg to this price leg. I search for like my 50%, which is resting above this liquidity area here. You see that there's this other block resting by this liquidity area. And then okay, so you see that there's this, I think it was in a smaller time frame. I don't think my trading view permit me, and I don't want to risk it, even though it's on premium. But from this area here, one can be looking to take a sell. Already, you can take a sell from the time. If you even go on smaller time frames, you can take a sell already from the 1 minute time frame or thereabout, targeting these areas of this, like somewhere like here now, or maybe here. But then wait for this break of structure here, and then we still have this giving us, we still have this giving us this level here. So within this price leg again, from this highs to this low, we have this from all the way to the top here as another order block, right? So I mean, you can decide to go in anyhow. Already you can see that we would have tapped in our trade from here and started playing it, putting our stop loss right here. But I always put my stop loss all the way up. Yeah, I don't like stress. And yeah, price came here again, tapped in, and I think that was basically it. Until we took our profits. So yeah, that's just an example of when price fails to close above. So you have to be able to wait out your what you're looking for in market, then you trade it accordingly. So I think at this time we're going to bring a close to our day 2 of week 2 episode of Smart Money Concept. And tomorrow we'll maybe rounding off liquidity and maybe think about the areas that we have not touched on. And see you tomorrow, guys. Take it easy.